While you're paying taxes on every dollar you earn, billionaires are living tax-free, using a strategy so simple it sounds too good to be true. They buy assets, borrow against them, and when they die, all those taxes disappear forever. Here's the brutal truth. If you're working a regular job, you're playing a rigged game. Every dollar you earn gets hit with taxes before it even touches your bank account. You work, you get taxed. You save, you get taxed on the interest. You invest and make money, you get taxed on the gains when you sell. But the ultra-wealthy don't live off paychecks, they live off wealth. And wealth, unlike wages, doesn't get taxed until you sell it. This is the fundamental difference that changes everything. Most people think you need to sell investments to access money. That's middle-class thinking. The wealthy know that selling triggers taxes, so they never sell their best assets. Instead, they've figured out how to access the value without the tax bill. While regular people are taught to pay off debt as quickly as possible, the wealthy use debt strategically to avoid taxes and build more wealth. They understand that not all debt is bad debt, especially when it helps you avoid paying the government. The first step in the buy, borrow, die strategy is accumulating assets that appreciate over time. This isn't about day trading or quick flips. The wealthy think in decades, not months. They focus on assets with high growth potential: stocks, real estate, private equity, or even valuable collectibles. The key is holding these assets for the long term, allowing their value to compound and appreciate significantly over decades. Here's what most people don't understand. Unrealized capital gains aren't taxed. If you buy a stock for $1,000 and it grows to $10,000, you don't owe any taxes until you sell it. The wealthy use this to their advantage by never selling their best performing assets. Instead of diversifying into mediocre investments, they concentrate their wealth in assets they believe will continue growing. This creates the foundation for everything else in the strategy. This is where the strategy gets really powerful. When the wealthy need cash for lifestyle expenses, new investments, or anything else, they don't sell their appreciating assets. Selling would trigger capital gains tax on all those profits they've built up over the years. Instead, they borrow against the value of these assets using sophisticated lending mechanisms. The most common tool is a securities-backed line of credit, or SBLOC, where you take a loan against your stock portfolio. Think of an SBLOC like a home equity line of credit, except your stocks are the collateral instead of your house. These loans offer flexible repayment schedules, easy approval with little to no cost, and often very low interest rates. The critical advantage is that loan proceeds aren't considered taxable income by the IRS. You're simply taking on debt that you're obligated to repay. This means the wealthy can access millions of dollars in cash without paying a single cent in capital gains tax. Securities-backed lines of credit are offered by brokerage firms and banks, allowing you to borrow against your non-retirement investment portfolios. You can use stocks, bonds, mutual funds, and ETFs as collateral. The loan-to-value ratios can go up to 70 to 95% for diversified, highly liquid portfolios. However, most wealth advisors recommend borrowing no more than 25% of your account balance for long-term use to avoid issues when markets get volatile. Interest rates are typically tied to SOFR, the Secured Overnight Financing Rate, plus a small spread. These rates are often lower than what normal consumers can access for personal loans or credit cards because the loans are secured by liquid assets. Getting an SBLOC should be much easier than getting a mortgage. You won't need extensive income documentation or lengthy approval processes. The securities themselves serve as collateral, making these loans relatively low risk for lenders. The final phase is where the strategy becomes truly powerful. Under current U.S. tax law, when someone dies, their heirs receive what's called a stepped-up basis on inherited assets. Here's how this works. Imagine someone bought stock for $1 million that grew to $10 million over their lifetime. If they sold it while alive, they'd owe capital gains tax on the $9 million profit. But if they hold it until death, their heirs inherit it with a new cost basis of $10 million. If the heirs immediately sell it for $10 million, they owe virtually no capital gains tax because their profit is zero. The entire $9 million of appreciation during the deceased's lifetime effectively escapes capital gains taxation forever. Any outstanding loans are typically repaid from the inherited assets, or the heirs can choose to assume the loan. This is why the wealthy never sell their best assets. They know that holding until death can eliminate decades of accumulated capital gains taxes completely. You don't need to be a billionaire to use versions of this strategy. Many brokerages offer SBLOCs to clients with substantial investment accounts, though the minimums vary. Start by building a diversified portfolio of quality investments that you plan to hold long-term. Focus on assets with strong growth potential that you believe will appreciate over decades, not months. Once your portfolio reaches a substantial size, research SBLOC options from major brokerages. Compare interest rates, loan-to-value ratios and terms. Some firms specialize in these products and offer more competitive rates. When using borrowed funds, be strategic. Use the money for investments that can generate returns higher than your borrowing costs, or for necessary expenses that allow you to keep your investments growing. Always maintain a conservative loan-to-value ratio. Even if you qualify for 70%, consider borrowing only 25 to 30% to protect against market volatility. Remember that this strategy works best for long-term wealth building, not short-term speculation. The wealthy use this approach because they think in decades, not years. The buy, borrow, die strategy reveals how the ultra-wealthy think fundamentally differently about money, taxes, and wealth building. While most people focus on earning more income, the wealthy focus on accumulating appreciating assets and accessing their value without triggering taxes. This isn't about getting rich quick or finding loopholes, it's about understanding how money really works and using the same legal strategies that have built generational wealth for centuries. The tax code is written in a way that favors asset owners over wage earners. The wealthy didn't create these rules, but they understand them and use them to their advantage. You can start implementing these concepts today, even with a smaller portfolio. The principles remain the same: buy appreciating assets, hold them long-term, and access their value through borrowing rather than selling when possible. If this strategy opened your eyes to how the wealthy really build and preserve wealth, subscribe to Stealth Wealth Hacks for more insider strategies that can transform your financial future. The ultra-wealthy have been using these techniques for generations. Now it's your turn to level the playing field.